Hey, good afternoon, and thank you to Jeff for allowing us to do this panel this afternoon. I was going to sit over here, but I realized I'm too short for those chairs, so we're just going to have to play it by ear. So, as I said, I'm Shelley King. I am the CEO of an organization called Natural Products Canada. We all know that there's a growing demand for products and technologies that are better for people, animals, and the planet, and that has, resulted in a $4 trillion global bioeconomy market. So what we do at NPC is we identify and develop and de-risk natural product or bio-based innovation. And we work with over 1,600 companies from coast to coast, and they develop diverse products and touch almost every area every industry, such as natural preservatives for food, probiotics for domestic and companion animals, and also do things like converting waste into compostable plastics. We help these companies through a combination of advice, capital, and connections, and we have recently released our Game Changers report. There was a few copies out on the front desk, but you can access it at CanadianGameChangers.ca, and that represents the over 80 companies that we have supported with some type of capital, whether it be equity or non-dilutive. And the Game Changers outlines the profile of the company, the challenge that they were trying to overcome, and then how they use this financial support from NPC to overcome those challenges. So to date, we've invested $9.1 million into these 80 companies. They have gone on to develop 260 new products. And keep in mind that these are very, very early stage companies with somewhere around 7 employees when we first invest in them. Through those products, those companies have generated $282 million in revenue. They have created over 400 new jobs, and they've increased exports by 52%. Most importantly, they've gone on to attract $480 million in follow-on capital, most of that coming from the private sector. So that means for every dollar that we invest, these companies are able to go out and attract another $53. So, we're just getting started, and it's good to talk to the panel today about financing, project financing, democratizing private markets, and beyond. So I'm going to let the panel introduce themselves. We're going to start with Susan.
Hi, everyone. Nice to be here today. I'm Susan Rohac. I'm the managing partner of the Climate Tech Fund at BDC. BDC is a Canadian federal crown corporation that supports Canadian businesses. Our fund is a climate technology fund. A couple of things to know about us. One, we only invest in Canadian climate companies, and Canadian technology companies. So what that means is companies got to be Canadian. The company does have to have a climate technology, meaning that it reduces or abates GHG reduction. And the third thing is there has to be technology involved there in the company. So it's usually companies that are developing and commercializing and patenting their own technologies. We are one of the largest and most active climate investors in Canada. We've got $1.1 billion of assets under management, usually coming in at seed stage or Series A and supporting the companies sort of right through to their growth cycle.
Thank you, Susan. Peter, Paul.
Hi, everyone. My name is Peter Paul van Hoeken. It's great to be here today. And actually, I met Jeff at the conference in Toronto where I was on a panel, and Jeff said, "Hey, maybe you should come to this conference and speak about indeed democratizing the private markets." So I'm the founder and CEO of FrontFundr. FrontFundr is Canada's leading online private markets platform, aka investment crowdfunding. And so what we're all about is basically enable private companies from early stage, pre-seed, all the way up to Series A, to raise capital from the public. And everything happens online. Now, just to circle back to the public, I really want to emphasize every member of the public can basically invest in startups. So whether you are a small retail investor looking to perhaps invest $500, or you are a larger so-called accredited investor and you want to invest $200,000, we can facilitate that through the FrontFundr platform. And the way we operate, we're a fully registered so-called exempt market dealer, an EMD. So we're supervised by the Canadian securities regulators in each province. So we're from coast to coast, including Quebec, all the way to the Atlantics, and we're fully dual language as well. And so we screen companies before we take them on the platform, take them through our due diligence, we list them on the platform, and then we open it up basically again for the public to participate. And so the entire process from onboarding and KYC, and we have to do a whole lot of compliance things to make sure that we onboard the investor properly, as well as the company. So that's why we perform this due diligence, and we facilitate the entire investment process through the platform. So if you want, and shouldn't really, should take more time and learn about investment opportunity, we can complete that process from start to finish in as little as 15 minutes, and you're basically done. From onboarding to completing subscription documentation, ID verification, transfer funds, everything. So a couple of quick numbers. We raised over 200 million through the FrontFundr platform to date for about 150 successful capital raises. We built a community of over 50,000 investors, and we transacted over 23,000 transactions through the platform. And the final comment is that the whole point for companies, and that's why I think this is also very interesting for this industry, is it's an opportunity for companies not only to raise capital, but also to create awareness around your company, your purpose, and to basically turn your investors into supporters, into brand champions as well, and have those investors shared with their networks. So the whole idea is that we really invite the public from the very beginning to fuel early stage projects all the way to Series A by opening it up for any investor, really. So I'll pause here.
Thank you. And last but not least, Duncan.
Thank you. Duncan Ramage. I've been a private markets investor developer for 20-something years. I did about 10 years at Macquarie, and then 6 years at a place called Forum. I left there a couple of years ago and set up my own shop called Circle Bay Capital, which is a small investment shop and an advisory shop that primarily supports developers. Seeing a big gap in sort of getting prepared for project finance and helping those developers co-develop and access capital. And my co-panelists have really important parts of the ecosystem. There are gaps. Not all capital is the same, of course, and so at different times along the cycle, it's really important to have partners who are constructive at different stages. So I'm happy to talk about PF.
Thank you. So I've got a couple of questions to start the panel off, but we'd be happy to take some questions from the audience, so you can either raise your hand, or I think there's somebody going around with a little note card. So Duncan, we'll start with you, since you were the last one to introduce yourself. Project finance, what do you want to know? What do you want the audience to know about that? What's the key challenges, the general status?
It's really hard. Yeah. I mean, a lot of different pieces need to come together. So the way I think about it is that the return profile is typically lower than in traditional private equity, where you're buying a company that you can see and has history and is already, operating. So, how do you invest in something that you can't really, see yet? You need to push risk out as much as you can, and so that comes down to, contracts, partners, just structure and de-risking as much as you can. And I think a lot of developers don't really sort of maybe intuitively understand that enough, or some of the technology around that's necessary to make something investable. And so I think that's a gap. And as you get prepared for project finance, project equity and project debt, the years or months before that, the development process is where you sort of establish that readiness. And there's some ingredients in that often aren't really present, whether it's team or expertise or sort of understanding what needs to get done. And often that takes a lot of money. So I think I echo Derek's comment earlier that one of the biggest gaps in the market, I think, is in the development capital side, like pre-FID, pre-NTP. Because frankly, if there's a well-structured, de-risked project with a good team and good economics, it'll get built. The problem is that most things that think that they're ready aren't ready, and so there's pieces along the way that haven't been put into place properly. So, feedstock, offtake, ops, logistics, project delivery / EPC, whatever structure you're going after for that, your technology risk. Try to push as much of that out of the project box as you possibly can, and then, of course, you're still left with some. And what we're talking about in this forum often is, first of its kind, innovative technologies, and that's been the tough one to crack, and it's nice to see folks like Munich Re and New Energy Risk with their technology process wrap / insurance product that helps establish ways of mitigating that, and then to your manufacturing partners and so on. So I'm rambling, but there's it's hard, and there's a lot that needs to get done before you get ready to approach the institutional markets, and a lot of that sort of gets missed, frankly.
Thank you. That's a good segue. Susan, feedback from our clients, even though we can tend to invest at a much earlier stage than you do, is that it's really been challenging the last 2 to 3 years to raise capital. So maybe you could give some insight, like you as a Series A, Series B investor, what do you expect from potential clients or investees at that stage?
Well, first of all, if they have found it hard, it's because it is hard. There has been, PitchBook, numbers don't lie, and PitchBook shows that climate investing kind of peaked in 2021 at $35 billion in North America and has been going down every single year since 2021. This year, it looks like climate investing in North America will hit $15 billion, which is really far off from a high of $35 billion. So capital markets right now, particularly for venture capital, are tight. And we can love to get into, hope someone asks the questions why, because there's a couple of really good reasons
actually,
why.
I was going to ask you why is that?
Well, I think it's unfortunately very much tied to interest rates, and it is the higher the interest rate, it is the less venture capital money is in the market, and we can do a little experiment to show you why if we've got the time at the end, but there's a good reason for it. So there is a scarcity of capital, and what's even more worrisome, I think, is Canadian companies, if you look compared to our counterparts in the US, usually raise about half the amount of capital than their counterparts do. And what that means is that you've got less money to do R&D, less money to hire the best resources, and less time in between rounds to create value. So your valuations are inherently lower when you go back out to market for your next round. Right. So it is very, very difficult to raise capital. I think what most investors are looking for when they're looking, it's back to the basics, quite frankly, is we're looking for companies that have good management, good market size, good product commercialization potential, and can execute, right? We can't put money into ideas. We have to put money into business plans and companies that can actually execute. So there's many, many pieces that we look for. I know because we're Crown Corp, people say, oh, well, like, what boxes do I have to check to get the money? It's not a box checking game, unfortunately. You can check every single box and we still can't do the deal for some reason, right? Including portfolio construction. We have to build a portfolio that's going to be profitable at the end of the day, and that means maybe we can't have, I'm going to make up 6 SAF companies in our portfolio. Maybe we can have only 1 or 2, and we've got to diversify to have companies that are in the climate space from a variation of different subsectors, because we do invest in many different subsectors, including like the battery supply chain, and we do absolutely energy and biofuels, but we also can do the build environment, and we're also looking at alternative proteins. So we've got to make sure we build out a diversified portfolio to ensure that the success of our portfolio is there.
Thank you. Peter Paul, tell us what we need to know about democratizing private markets that we can't just read in a book or look at your website.
So there's so much to tell about that, but maybe just to put it in perspective, and actually you were speaking about the private markets, and funding became really tight, certainly in the last couple of years. And so if you look at what traditional investors invest, so traditional VC investors like angels, VCs, and other early stage investors invest per year. If you look at multiple sources, you're roughly looking around, and this is really early stage. I'm not talking about private equity. This is really early stage venture capital. Looking roughly around 350, so let's say half a billion per year. So if you would open up these investment opportunities to the public, and the public would invest, say, 0.5% of their annually accruing investable assets into the private markets. Because keep in mind, there are already 30 million Canadians on, direct investing platforms investing in the public markets, right? So they're already participating. Now, if the 0.5% of the Canadian public, the 0.5% of their investable assets would be directed towards the private markets, you're looking easily at about 1.5 billion per year. So that's already like triple as much as now going into early stage investing. So if you find a way, and that's what we built with FrontFundr basically, is to unlock the private markets for the general public to participate, you're basically making much more capital available for startups. So I think that's one thing that definitely I think it's important to know. And just to put it in perspective, FrontFundr we launched, there was a lot of work to be done. I think it's fair to say that I've been sort of pioneering this in Canada, working with securities regulators, getting their comfort actually for, it's actually a good idea to open this up and make private markets accessible for retail investors, but it's got to be done properly. Investors, you need, make them, let's say, informed as best as possible so they can make informed investment decisions, because of course early stage investing is risky. So you want your investors to understand, don't put all your RSP in it because you might lose everything, right? So we've taken that very serious, and this is the reason why I also took the time, a long time actually, took about 1.5 years with the securities regulators to figure out how to do this, to build a platform that's fully compliant and takes care of all these, let's say, obligations. So for the general public to participate in early stage companies, as I said, unlocks a massive pool of capital, and really can be part of, let's say, the funding mix for startup companies, in addition to traditional capital. And this is what I want to say. In the UK, where investment crowdfunding started about 5 years earlier compared to Canada, so around 2010, already around 40% of startups are raising capital from the public. So it already went Main Street, basically. Main Street investors can participate. And in fact, what's exciting to see there is you see traditional investors like angels, VCs, and going hand in hand with with retail investors, basically. So that's really, my vision also for Canada, to get it to that level where you really engage this massive pool of capital and direct just a small portion even to private markets.
Right. Thank you. Are there any questions from the audience? Okay, so everybody's been quiet since we're all used to doing business on Zoom. So we've reached out to some of our clients to say, if you could ask these people anything, what would you ask? So one of the questions that came back, and Ron from Sixth Ring, one of them is yours. So if I don't get to it, you can please ask it. So are there special rules or allowances for companies that are in more sustainable, kind of game-changing technologies? Are investors usually more patient in that situation? And is purpose relevant? Anybody?
So I'll be honest, patience means more time.
Yep. Time
kills returns. So most venture capitalists don't like long investments, right? Time value of money. I mean, if you're going to invest $1 million and someone says, I'm going to give you back $1.5 million in 5 years or in 10 years, which one would you pick? The answer is obvious, right? You want your money back in 5 years. So I would say that in general, no. Right now in Canada, there are not any investors that would that would say patience is good, because that means more time, unfortunately.
True. Duncan.
Groundbreaking, world-changing technologies are words that you should never use with the project financier. It's an evolution, not a revolution, right? Otherwise, it won't get banked. I mean, that's maybe the philanthropic buckets of capital and maybe some pockets of government capital are good for that. But there's no patience in institutional capital typically, and you won't get a properly structured project financing done if there's a ton of technology risk.
Thank you. Peter Paul, did you want to
Just to add, just to add to that, and I think that's one of the things we always want to make very clear to investors through FrontFundr is, this is it's going to be a long haul flight. So sometimes like, hey, when can I exit? When am I going to get out? Well, the truth is really, and not anytime soon. So we typically want to make sure investors understand, like, look, you're looking at least at 5 years, 10 years in your investment. So that's also the reason that it's typically money that you're not looking to liquidate anytime soon. And if that's the purpose, you shouldn't invest in private companies. You should then put it in the public markets, make sure you maintain your liquidity. We have seen companies, by the way, that are later stage private companies that are on the way to go public. So basically they do a private raise before. Is my mic still working? Is it working? Yeah.
Sorry?
No, it's still working, my mic? Yeah.
Yeah, no,
So we have had a few companies that were later stage, and then before they go public actually do a private placement through FrontFundr. So we've seen the outlier raised on FrontFundr, do private placement and go public 2 years later. Those are the exceptions, really. So yeah, you got to be patient.
Okay, thank you. A couple of different points of view there. So this is one from the audience. So certain components of the supply chain are more exciting for funders, not necessarily financially based. How does one raise funds for parts of the supply chain that are less attractive? For example, harvesting and transport of biomass. Again, open to any of you.
Quick response from my end. Yeah, that's actually challenging for sort of my, let's say, channel of funding, because there's sort of low-hanging fruit, if you like, for investment, for raising funds from the public, if it's generally easy to understand and it's something that I can get excited about, right? So there are lots of great companies come to us that are totally viable, great investment opportunity, but it doesn't necessarily sort of resonate with the general public, and this could be an example of that. So it's another one in other sectors, for example, enterprise software. Great companies out there, but the general public might just have a bit of a hard time to understand that. So in this case, it's probably from my funding solution sort of more challenging to fund these kind of projects.
Duncan, Susan?
Just to replay the question, was parts of the supply chain highly investable as well as the projects or the technology?
Yeah, it says if there's less valuable, how do you raise funds for parts of the supply chain that are less attractive? So harvesting or transport of biomass.
I mean, most institutional investors aren't purpose-driven, let's call it, right? It's not about how exciting it is, right? I mean, often it's what's the risk-return profile.
Yeah.
With exceptions of I won't go there, but logistics is very sexy. Come on.
Okay.
Yeah.
Yeah, I mean, I don't disagree. I think there's a risk-adjusted return that is part of the equation when you're looking to make an investment, just like when you're probably looking to place your personal money,
right,
and you do the math and you figure out, is this a sector, industry, or an instrument or a company that I can make money on? What's the risk? Am I getting a good return for the risk that I'm taking? So some of those more, I would say, traditional service businesses that are adjacent to some of the other businesses could be really interesting opportunities for equity placement, but also maybe a better instrument to have a debt as well that is non-dilutive and is debt and repaid through the cash flows of the company and not dilutive. So I think it's case-by-case basis, but I wouldn't exclude sort of more traditional adjacent businesses from being part of the being able to raise funding or capital.
Okay, thank you. So next question, and I wish I knew the answer to this. What will be needed to enable enhanced engagement of Canadian banking systems in the bioeconomy?
In the modern economy?
The bioeconomy. This could be a stumper.
we should see them lending into these projects. Why aren't they? Often because it's too risky a project. It's not a cash flowing business, so it's breaking their mold, so it's in their project finance group, and the project finance group is used to looking at things with guaranteed revenues, fixed price project delivery, fixed price feedstock, and so on. And when those things aren't there, or there's a wild card technology risk, then they don't have any upside. So. Yeah.
Okay. This is another one that I don't know the answer to. So strategics are looking for 20% IRR. It's not really possible to deliver that on the first plant or 2 plants or 3 plants. So how do we overcome that? It's tough crowd here today.
Give them equity.
Sorry?
Give them equity in the DevCo or the TechCo.
Susan, Peter Paul?
Yeah, I would agree with that. I think certainly, in the early stages, the best way to fund that is equity, and that's where I think you also sort of compensate for the typical early stage risk, which is obviously significantly higher. So I think that's where the solution is really.
Okay.
And give them an exclusivity on the future projects and demonstrate to them that they will be more economic, right?
Duncan, this one is specifically for you, but Susan and Peter Paul, you may have some comments as well. So the question is, at later stages of commercialization, when capital needs are larger, for example, to construct your first commercial plant, and technical risk is falling but still not to zero, there appears to be a limited number of investors. So any insights on accessing capital at this stage would be helpful, and what are the table stakes to raise capital to build a plant?
I mean, I sort of touched on a lot of that stuff earlier. I mean, if it's well structured, there's capital. I think there are quite a few sort of energy transition focused project investors now, especially over the last sort of this vintage of funds. There's been quite a few that have been raised, and so they're ready to deploy. But the rigors of project finance don't just sort of go away. I think there's been a couple slip-ups too, frankly, in 2021, 22, that especially new funds got out over their skis and forgot some of the first principles, and some are, licking their wounds, and so they'll probably see a little bit of hesitation.
Okay.
But yeah, like the money's there if it's well structured, I think, and it is nice now that there are definitely more sort of smaller funds out there, $100 to $400 million sort of funds that are focused on the space, that have real, depth of expertise in these subsectors, and some of these subsectors are getting more traction, right? RNG is much more investable, et cetera.
Yeah, and I think if you look, 15, 20 years ago, and this was a room full of wind and solar developers, you'd be hearing the exact same thing, right? Exactly. They would be saying, no one wants to fund us, we can't find the big check sizes. Now fast forward 15, 20 years, and these projects are like commodities. They're very fundable, right? Why are they fundable? Well, we've got some certainty around the offtake. We've got some certainty around the feedstock, right? Wind and sun. There's some certainty around the cost of the equipment and the longevity of the equipment. So I think, time heals all wounds in some ways, but it certainly proves out what projects are fundable and can be done, and then every single one gets easier and easier. And I think that's the direction that biofuel is going to go as well, is we're sort of at that sort of messy beginning stage now where everyone's jockeying for what can be fundable. There will be projects that can be proven over and over again that come out of this, just like wind and solar, and then it'll be on to the sort of next technology after that. So I'm pretty confident we're going to get there. Probably not as straightforward as wind and solar, because the inputs and the offtakes can vary more as well. But I think we're going to get there. It's just you got to get through this hard spot first before we get to the end.
That's fair. So we're just about at time, so thank you to all three of you to take the time today and come and have a little chat with us. And again, thank you for having us.